Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning. It's Quincy Krosby. This is The Talking Point, Monday morning, June 5th. Thank you for joining me on the call. Friday's market action was much needed, much applauded. And as you could see, we moved on the S&P 500 up above 4,200 S&P 500. You know, you look at these resistance levels, and then now you look at the next resistance level, which is 4,300. That is going to be an important move in the S&P 500 if it can launch a strong, deliberate move beyond that. We saw the volume pick up, which is good news, but also a very important element in the market. We saw a broadening out, and that came from the Russell 2000. This is important because it had been, as everyone knows, the 7 big mega cap tech names leading this market higher. We needed to see a broader demonstration that there was more to the market than just that. And why the Russell 2000 becomes important is this: it represents the small cap names and mid cap names. And one other aspect to it is that it is also home to the small banks and many of the regional banks. And therefore, having that profound climb higher, over 3% on Friday afternoon, if we can follow through this week, would be suggestive of an economy that is holding up. And the reason I say that is the Russell 2000 tends to be one of those bellwether indexes about the economy. The small cap names, as everyone knows, does better as an economy is performing well and coming out of a recession. We always start looking at the small caps. Are they starting to perform? Indicative of a recovery. But as you know, it's been very difficult for the Russell 2000 to gain that momentum. And obviously, we're looking for this week to see if it can follow through. It's always about follow through in markets, making certain that something isn't just a one-off, a one-day event. So there's going to be quite a bit for this week to underpin the view that the market is looking at a stronger underpinning, a recession that is not just around the corner, but perhaps pushed out a bit into the future, which is what most of the analysts are suggesting now. Now, all of that said, we have to look at some important issues. Many have looked at the labor market report on Friday and said, see, this is the reason the headline number was great. There were so many jobs. That's true. And that is what helped spur the market. But also keep in mind that the market has been signaling that it doesn't see a rate hike coming on June 14th. Now, by the way, the Fed is now in that blackout period where it doesn't speak until that meeting on June 13th, 14th begins. But the last words coming from the gentleman who is a Fed governor, that is Philip Jefferson, he is the nominee to be the vice chair at the Fed. And he gave a talk twice last week in which he said, we expect to see a skip. That's what we should do. We should skip over the idea of a rate hike or rate cut, whatever, any rate movement for June 14th. The mere fact that he spoke that way, many in the financial markets thought he is speaking for Jerome Powell. And even though he has just been nominated for vice chair, he hasn't been confirmed by the Congress. And this is, again, why it's interesting, because he had been for so long saying we need to pause, we need to monitor the 500 basis points of rate hikes that's still in the system and unfolding into the deeper, broader market. But he changed his wording and he said, no, we need to skip. That was followed up, by the way, by a Fed president, Patrick Harker, who's president of the Philadelphia Fed Bank, who's considered to be a pragmatist, he also said we need to just skip the meeting. The Fed funds futures market, by the way, for probability of a rate hike on June 14th has come down quite dramatically. Now, going back to that employment report, I want to indicate something. You know, all the numbers, the headline number, the household number, the conflict between the two. But there was one that I think is extremely important, and that is the hours worked. The reason I mention this is that when an economy is doing very well, the need for more hours is implicit in the work week. What we saw, however, was that the hours worked came down. The hours worked was 34.3 in May. That had come down from 30.4 hours in April, and from 34.6 hours just a year ago. What you do not want to see is the hours work coming below 34.5 hours a week. So this is something that is, you know, in the market's eye, like, hey, wait a minute, are we seeing demand coming down? Is this a one-off, or are we seeing demand coming down? Now, we are going to see the ISM, Institute for Supply Management, services report. And that report is going to be very important for the market because remember, we're a service economy. We are not a manufacturing economy. And in manufacturing, the one thing we saw is it is in contraction territory. It is not expanding. But the good news there is that prices paid has started to come down. What we're looking for in this ISM service sector report is, are we seeing new orders up? Does it remain in expansion territory, which it has been, which, by the way, is above 50? And what are the prices paid showing? This is going to be important this week. This week, the market, there's not that much other than the ISM factory orders. You don't have Fed Reserve speakers out there. Many of us take a big sigh of relief when they stop speaking. But overall, it is a market that is wondering whether or not the worst is in. Is the worst in? Are we finished with that? And can we now start to move in a market that has taken care of the debate on the debt ceiling? The issues facing the market, however, are the following. It's expected that the Treasury Department is going to have to raise money, right? You've seen how they have come up with another X date, right? What is it, June 5th or June 6th? They may have to push it out a little bit more. But all of that takes money, right? They're going to have to raise money. And the expectations are that the Treasury Department is going to have to raise about $1.1 trillion. How do they do it? Well, they sell bonds. And the expectations there are that, you know, they're going to have to deliver an attractive yield. The question then becomes, do we see then that money comes out of banks and go looking for higher yields? It's obviously, we all know why that's important and the effect it could have on the banks. So that's one thing. The other part of it is it extracts liquidity from the market. How much, we don't know yet, but even the mere cent, that's SCENT, of liquidity being depleted in the market is a negative for the market. Liquidity, I always say this, liquidity is like the oxygen for human beings. Liquidity for markets is extremely important, but that's a big unknown, whether or not that is going to happen. So this is something that the market has to focus on over the next couple of months. But we see initially what the Treasury Department does in terms of the auctions. That's how they sell their bonds. They can't do it until everything is signed, sealed, and delivered with the debt ceiling. So there's a waiting period. The other thing going on this week is in the oil market, and I want to go over that for a minute. Saudi Arabia at this past weekend's OPEC meeting came out unilaterally, meaning going alone, that they are going to cut production in oil. Keep in mind that the Saudis have an enormous budget. They've always had an enormous budget, a domestic budget to take care of welfare payments and payments to foreign workers, on and on and on. But now, as they prepare for a post crude oil, so to speak, world, they're transitioning. They're building new cities. And the estimates are that they need a price per barrel of crude oil between $78 a barrel and $82 a barrel. Needless to say, they'd like to see it higher. But every time there has been a cut in production, the demand side of the equation has basically thwarted the ability for them to see a floor on the prices. So this is important as to whether or not the market can keep the jump up over $70 in West Texas Intermediate crude, that's the U.S. benchmark, and keep it all week. Because what we have seen is it jumps up. It had jumped up 4% after the announcement was made on Sunday. But it is back now to about 2.5% up. We'll see if it could hold it. What we're seeing this morning, as I do this call, Monday morning, is the big integrated names in oil are up on this news. But again, the question is, can it hold? Part of the answer to that is whether or not the Chinese come in with a package of some sort of infrastructure spending, but a package that is focused on the industrial sector. Right now, they have a targeted approach on the property market, which is mired still in debt and is slow to recover. But that's not enough to get the price of crude oil up, the price of commodities up, although it did jump. Commodity prices jumped, crude oil prices jumped when the announcement came that they were going to come in with a targeted approach to help electronic vehicle sales and also the property market. The reason for that jump up is that the market's expectations now have moved to a broader package that may be forthcoming, a package that could help assuage the fears that the unemployment levels, which are over 20% for, especially for young people, has to be addressed. And the only way that you can address that is to create a package of stimulus from the fiscal side of the equation, not from the bank side of the equation, which is monetary policy, that can absorb new workers. That would obviously put a floor under many of the commodity prices and also oil. Oil demand, remember, China is the largest importer of oil. By the way, just on the other side of the ledger, the U.S. is the larger user of oil. So all of this has to be, sorted out. It's anticipated that the Chinese may be forced to do this, but we don't know. We do know one thing. They don't want any more debt because the debt is and the property market and also municipalities that typically, when there is a big project, they've got to be involved, but they are mired in debt as well. The Chinese authorities have been almost determined not to allow debt to underpin any sort of major projects. So there's a lot for the market to absorb. The question right now is, can the S&P 500 hold above 4,200 and push to 4,300? That is the next resistance level. And can it be done by broader participation? Because the big tech names, the 7 big tech names keeping this market up, are becoming a bit frothy in terms of their valuation. So it's a lot for the market to absorb this week, and we need to see if the market can climb higher. Now, one thing I do want to add is that we're at the beginning of a month, new money comes into the market, and money needs to be placed, and that tends to help volume in the market and also, helps the markets climb higher. But that tends to dissipate as we get into the first week of the month, which we're already in June 5th. So a lot for a market without a busy economic calendar and no Fed speak. So it's a market, as we like to say, left to its own devices. So have a good week. We'll be back next week. Thank you all so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.